What if I told you that a massive financial institution made an extra $117 million in a single quarter?
Yeah.
Literally, just because fewer people died than their math predicted.
It is a pretty wild concept when you say it out loud like that.
Right. I mean, when you look at a towering skyscraper, you marvel at the glass, the steel beams, the architecture, but you never actually think about the rebar.
Right. The stuff holding it all together.
Exactly. The steel bar is hidden deep inside the concrete. You never see it. But if that rebar cracks, the entire building just comes crashing down.
It's the perfect way to frame it, honestly.
Welcome to a special deep dive into the hidden architecture of the global financial system. Today, our mission is to decode a company that is essentially, well, the financial rebar of the global economy.
The Reinsurance Group of America, or RGA.
Yep, RGA. And for you listening, we're talking about a company sitting on a mind-boggling $164 billion in assets.
Yeah, they operate completely behind the scenes. They are essentially the insurance company for insurance companies.
Which is such a weird business model to wrap your head around.
It is, but think about it. When a consumer-facing brand takes on way too much risk, they quietly offload it to RGA. They're this invisible giant.
And we've got a massive stack of sources today. We are going through their Q1 2026 earnings report, the call transcript, the presentation deck, and the numbers they just dropped are staggering.
Oh, they totally crushed expectations.
Literally blew past them. Wall Street was expecting an adjusted operating earnings per share of $6.03. RGA reported $6.97.
Nearly a full dollar beat.
Right. And revenues jumped 23.5% year over year to almost $6.5 billion. For a company whose entire business model is just absorbing the world's risks, how do they manage to have such a wildly profitable quarter?
Well, if we connect this to the bigger picture, RGA's success right now isn't just about clever financial engineering.
Okay, then what is it?
It's fundamentally about human life, death, and health trends. They are succeeding because the real-world data regarding human longevity is actually proving to be better than what their historically modeled expectations predicted.
Okay, let's unpack this, because to understand this financial beat, we first have to look at the human element, right?
Yeah.
Which RGA coldly, but I guess accurately, calls biometric claims experience.
Yeah, actuaries have a very specific way of talking about life and death.
Biometric claims. It sounds like something out of a sci-fi movie.
It does, but biometric claims is really just the industry term for measuring how many people are getting sick and how many are passing away compared to what the actuaries originally predicted when they priced those policies decades ago.
And in Q1, RGA saw that massive $117 million favorable economic claims experience across all their regions.
Right, which was largely driven by U.S. individual life policies.
Just $117 million in one quarter. But looking at the sources, this isn't like a one-off fluke, right?
No, not at all. Since 2023, this cumulative favorable experience has piled up to $343 million.
But here is where the accounting gets kind of weird to me. They don't just dump that massive windfall onto the balance sheet all at once.
Right, they defer it.
Yeah, they expect to recognize about $20 million of profit annually going forward just from this backlog through something called deferred profit emergence.
Which sounds incredibly dry.
It does. But wait, if they made the money now, why are they deferring it? Isn't that just some sort of accounting trick to smooth out their earnings and, keep Wall Street happy with steady numbers?
I mean, it sounds like a trick, but it's actually a super strict regulatory standard.
Really? How so?
Well, in life insurance, policies last for decades. Regulators don't want an insurer to recognize, 30 years of projected profit on day one, pay it all out as executive bonuses, and then just go bankrupt in year 10 when claims suddenly spike.
Oh, that makes total sense, so they hold it back.
Exactly. Accounting rules force them to amortize or spread out those unexpected gains over the remaining life of the policies. So that $343 million backlog acts as this guaranteed slow drip revenue stream for years to come.
Okay, that makes sense from a safety perspective.
Yeah.
But let's look under the hood of that specific Q1 number. Historically, the first quarter is notoriously tough for life insurers, right? Because of the winter flu season.
Yeah, respiratory illnesses spike, and unfortunately, mortality usually goes up. That's the typical pattern.
But that didn't happen this year.
Well, during the earnings call, their chief risk officer, Jonathan Porter, pointed out that this year's flu season was relatively moderate, and it actually peaked early in December.
Oh, so because it peaked before the new year, it hit the Q4 books instead of Q1.
Exactly. That traditional Q1 mortality spike just wasn't as severe for their 2026 books.
Okay, but there's a missing piece to this puzzle for me. An early flu season explains, a small bump. But mortality trends improving this much, to the tune of hundreds of millions of dollars over a few years.
It's a huge shift.
I have to push back here. Is this just a grim COVID pull-forward effect?
What do you mean by that?
Meaning, unfortunately, the most vulnerable populations already passed away during the pandemic, right? Which artificially lowers the current mortality rates because the surviving population is just statistically hardier. Or are we seeing the impact of actual medical breakthroughs moving the needle on human longevity?
That is the exact question the analysts on the call were pushing on, and the answer is highly nuanced. RGA was very careful to state that they haven't officially rewritten their long-term foundational pricing assumptions just yet.
Because they need decades of data for that, right?
Exactly. You can't change a 30-year model based on 2 years of data. But they are watching the near-term data like hawks, and they provided some truly fascinating commentary regarding GLP-1 drugs.
Oh, wow. Okay, so we were talking about the Ozempics and Wegovy's of the world. The weight loss medications.
Yep.
Are they actually extending lifespans or just, delaying immediate cardiac events?
Well, from an actuarial standpoint, delaying a cardiac event by 10 years is effectively extending a lifespan.
Oh, right. Because you keep paying premiums and not claiming the death benefit.
Exactly. And what RGA noted is that the rising accessibility and the lowering prices of oral GLP-1s.
Wait, the pill forms, not just the injections.
Yes, the pill forms. That is changing the game, especially now that we're seeing increased Medicare and Medicaid coverage for them.
Because that means it's not just a luxury drug anymore.
Precisely. It means these drugs aren't just for wealthy patients paying out of pocket. They are reaching population-level scale. And this gives RGA a very high level of confidence that the positive mortality improvement assumptions they've cautiously built into their models will actually materialize.
So they have this massive windfall from people living longer. But in reinsurance, you can't just leave $343 million sitting in a checking account.
No, inflation simply eats it.
Right. You have to deploy it, which forces RGA into the market to aggressively buy up more blocks of risk. The sources call these in-force transactions.
Yeah, and in Q1 alone, they deployed $338 million into these deals. That is their core growth engine.
So how does that work exactly?
Basically, when another insurance company wants to get out of a specific market or they just need to free up capital, RGA steps in and buys their existing, already enforced policies.
Okay, so what does this all mean? The CEO, Tony Cheng, repeatedly emphasizes this as their sweet spot. He stated they look for deals that combine both biometric risk and asset risk.
He even called RGA a one-of-one player in this arena.
But what does that actually mean in plain English? Because the way I'm reading it, it's like, okay, think of it like buying a portfolio of mortgages from a bank, but instead of just taking the interest rate risk, you are also taking the risk on the actual physical lifespan of the homeowners.
That's a great analogy.
It requires this crazy rare dual competency. Because while other insurers are just acting as bouncers at the door trying to keep bad risks out, RGA is acting like a casino actuary.
Right, calculating the odds on everything.
Yeah, calculating the odds on both the games being played, meaning the biology of the policyholders, and the chips being used, meaning the underlying investments backing those policies.
That captures the dual nature perfectly. Let's take coinsurance, for example, which they executed multiple times in Asia this quarter.
How does coinsurance differ from regular reinsurance?
Well, in standard reinsurance, RGA might just say, we will cover the death payout if it happens, you just pay us a premium. But in coinsurance, RGA takes a proportional share of everything.
Everything.
Everything. They take the premiums, they hold the reserves, they manage the investment assets, and they pay out the claims.
Oh, wow. So they really do need world-class doctors and actuaries to understand the biology and world-class asset managers to grow the investments.
Exactly. And because they have that dual competency, they don't have to compete purely on price. They can be incredibly selective and just walk away from deals that don't meet their strict return thresholds.
And we saw them execute this all over the world, right? They expanded a massive U.S. partnership into Canada, closed those Asian coinsurance deals, and executed an exclusive deal in EMEA, Europe, the Middle East, and Africa.
Right. And what's fascinating here is how this specific expertise insulates them from regulatory changes. Let's look at the UK longevity market.
Okay, what's happened there?
The UK regulatory body, the PRA, is considering strict new rules. specifically funded reinsurance counterparty charges.
Which means what exactly?
Basically, they're making it harder and much more capital-intensive for UK pension funds and insurers to offload their risks.
That sounds like it would completely freeze the market and hurt a reinsurer like RGA.
It would hurt a typical reinsurer. But RGA's structure protects them. 90% of their UK longevity business is done on a pure swap basis.
Okay, I want to make sure we get the mechanics of a longevity swap right for the listener.
Sure.
Let's say a UK pension fund owes retirees money until they die. If medical science improves and a bunch of retirees live to be 100, the pension fund goes broke.
Right. Longevity is a huge risk for pensions.
So RGA steps in and says, we will pay you a fixed amount every month to cover those checks, protecting you from the longevity risk. You just pay us a premium.
Yep.
But RGA does not take over the pension fund's underlying stock and bond portfolio, right? They don't touch the assets.
Precisely. RGA just takes the biological longevity risk, not the asset risk, in those specific UK deals. And because they aren't taking the assets, the new PRA rules about asset counterparties barely touch them.
Oh, that's incredibly smart.
It is. In fact, this regulatory shift will likely push more clients toward highly rated stable counterparties like RGA who can actually execute these pure swaps. It takes a potential industry roadblock and literally turns it into a competitive advantage.
Okay, I want to pivot here because funding all of this global maneuvering requires cash, like a lot of it. We are looking at a vault of $142 billion in cash and invested assets.
It's a staggering amount of money to manage.
It is. And I'm looking at that asset pool and frankly, looking at the broader economy, I'm kind of nervous. The headlines right now are dominated by commercial office spaces defaulting, property values plummeting. How much of that $142 billion is trapped in empty downtown high-rises?
It is the absolute most critical question for any financial institution right now. To answer it, we have to look at the hard data from their presentation slides, starting with the current interest rate environment. Right now, new money coming into RGA is being invested at a rate of 5.64%.
Hold on, let me look at the sources. The deck refers to this as a higher non-spread book yield.
Yes.
For the listener who isn't, a bond trader, what exactly does non-spread mean in this context?
It's an important distinction. A spread business is when an insurer takes your money, promises to pay you 4%, invests it at 5%, and keeps that 1% difference. That's the spread.
Okay, so what is non-spread then?
Non-spread refers to the pure return RGA is generating on their own foundational capital investments, where they don't have a specific guaranteed payout tied to it. Their older historical non-spread yield was 4.85%.
Oh, okay, so they've jumped from 4.85 to 5.64% on new money.
Exactly. They are earning significantly more on every fresh dollar coming in the door.
But a 5.6% yield doesn't mean much if the underlying asset, like an office building, is in foreclosure.
Right. Which brings us to the headwind. In Q1, their variable investment income missed their 7% expectation by about $8 million.
And why was that?
This was primarily due to a completely frozen real estate market. They just couldn't get the sales or realizations they expected from their real estate joint ventures because the market for buying and selling commercial properties has basically stalled.
Right, so we are back to the office space crisis. Is RGA sitting on a portfolio of bad loans?
The data paints a surprisingly safe picture, actually. Office commercial mortgage loans represent a microscopic 1.2% of RGA's total cash and invested assets.
Wait, really? Just 1.2%?
Yes.
Wow. They barely have any exposure to the very thing dragging down all these regional banks.
And the exposure they do have is heavily insulated. The loan-to-value, or LTV, on these specific office loans is a very conservative 66%.
Okay, let me translate that mechanism just to be sure. If a building is worth $100 million, RGA only loaned the owners $66 million against it.
Correct.
So the market value of that building would have to drop by a full third before RGA even begins to risk a single penny of their principal.
Exactly right. And the debt service coverage ratio, the DSCR, is a very healthy 1.89 times.
Meaning the building currently generates enough cash flow from rent to pay RGA's mortgage almost twice over.
Right.
So even if half the tenants move out, the mortgage still gets paid.
Precisely. RGA has insulated itself by heavily favoring completely different sectors. 33.9% of their commercial real estate is industrial, so warehouses, distribution centers, basically the backbone of e-commerce.
Which is booming.
Exactly. And 31.3% is retail. But they made a very specific point to note they have zero exposure to traditional enclosed shopping malls.
Zero malls.
Yeah.
That's incredible. So they entirely sidestepped the two biggest financial sinkholes of the decade: urban office towers and dying shopping malls.
They've been remarkably disciplined, and we see that same discipline in their private credit portfolio, too, which makes up about 9.1% of their total assets. That's $12.9 billion.
Private credit is basically lending directly to companies instead of buying publicly traded bonds, right?
Right.
It can offer higher yields, but it can also be incredibly risky if those companies go bankrupt.
It definitely can be. But the vast majority of RGA's below investment grade private credit consists of first lien senior secured middle market loans.
First land, meaning if the company goes under, RGA is legally first in line to get paid from the liquidation.
Exactly. And they don't just buy these blindly from Wall Street. They have an internal team of 25 credit experts underwriting every single loan themselves.
Okay, let's summarize the state of play here. Mortality trends are vastly outperforming models, generating hundreds of millions in deferred profit. They are aggressively buying up complex global risk blocks while completely sidestepping UK regulatory hurdles. And their investment portfolio is shielded from the real estate crash while generating higher yields.
It's a pretty unbeatable combination.
When a business operates with that level of structural advantage, they end up with a mountain of excess cash.
Oh, absolutely. The reports show RGA is sitting on $2.4 billion in estimated excess capital, with $2.9 billion in deployable capital projected for the next 12 months alone.
So how do you deploy almost $3 billion?
Well, first, you return a portion of it to the people who own the company. RGA deployed $50 million into share repurchases this quarter.
Which brings their total to $175 million, since they resumed buybacks late last year.
Right. Their stated target is to return 20 to 30% of operating earnings directly to shareholders over the long term.
And buybacks shrink the number of shares, making every remaining share more valuable. But returning capital is standard corporate playbook. Here's where it gets really interesting. Their next move is truly innovative.
The sidecar.
Yes. They are finalizing the deployment of a third-party capital sidecar vehicle called Ruby Re.
Ruby Re is a fascinating mechanism for capital efficiency.
Let's break down how a sidecar actually works for the listener. Imagine a world-renowned master chef. That's RGA. They want to open a massive new restaurant.
Yeah.
But instead of draining their own savings to buy the ingredients and lease the building, they let outside investors put up the cash.
Right.
The chef still designs the menu, cooks the food, and runs the kitchen. And for doing the work, the chef gets a generous cut of the profits and management fees while taking on zero financial risk themselves.
That is exactly what Ruby Re is. RGA finds the insurance deals, manages them, and takes a fee, but uses outside investors' money to fund it.
But why do outside investors want to put their money into an insurance sidecar?
Because it provides uncorrelated returns.
Meaning it's not tied to the stock market.
Exactly. If the stock market crashes tomorrow or tech stocks plummet, people don't suddenly start dying at a faster rate. The returns from a life insurance portfolio are almost entirely detached from the volatility of the S&P 500. Investors are absolutely desperate for that kind of stability right now.
That makes perfect sense. But creating these complex financial vehicles always attracts the eyes of regulators. The NAIC, the governing body for U.S. insurance regulators, recently rolled out Actuarial Guideline 55, or AG 55.
Yes.
I know this is a massive topic in the insurance world right now.
This raises an important question because it is the defining regulatory battle of the moment. AG 55 is designed to tighten the rules on asset adequacy testing. For years, insurance companies have been using offshore reinsurance deals, moving risk to places like Bermuda or the Cayman Islands.
Because in Bermuda, the regulatory capital requirements are lower. Right. You don't have to hold as much cash in reserve to back up the policies. It frees up money.
Exactly. But U.S. regulators hate this. They worry that if a massive crisis hits, those offshore entities won't actually have the cash to pay the claims, and the U.S. parent company will collapse.
So what does AG 55 do?
It forces companies to rigorously prove that the assets they are holding offshore are adequate to meet U.S. standards. It is an absolute auditing nightmare for the industry.
So does AG 55 cripple RGA's ability to do these big deals, including stuff like Ruby Re.
This is where RGA's structure shines again. CFO Axel Andre addressed this directly on the call. He noted that AG 55 has no material impact on RGA whatsoever.
Wait, none? How?
Because unlike competitors who rely heavily on Bermuda, RGA primarily uses their onshore flagship entity, RGA Re. It is a fully regulated, heavily capitalized U.S. entity that meets all the strictest domestic standards anyway.
Oh, I see. So when another insurance company wants to offload risk, they can send it to RGA Re in the U.S. and completely bypass the AG55 offshore auditing nightmare.
Precisely. Once again, what acts as a regulatory wall for their competitors simply makes RGA's onshore value proposition that much stronger.
It's incredible. Every time the market or regulator builds an obstacle, RGA's architecture allows them to just walk right past it.
Yeah.
So let's bring this all together. We set out today to understand how this invisible giant blew past Wall Street's expectations. What the sources reveal is that RGA's blowout Q1 2026 isn't a fluke.
No, it's not a lucky quarter fueled by a moderate flu season. The success is entirely systemic.
It's the result of highly disciplined underwriting, knowing exactly when to walk away from a deal. It's an insulated investment portfolio that saw the office real estate trap coming and completely avoided it. It's their unique ability to structure complex, dual-risk coinsurance deals globally.
And it's their capacity to leverage outside money through vehicles like Ruby Re, all while sitting safely onshore away from regulatory crosshairs. They are operating with a structural advantage at almost every level of the business.
But why does this matter to you, the listener, beyond just the mechanics of corporate finance? Why should you care about the quarterly earnings of a reinsurance giant?
Because it tells us something bigger.
Exactly. Because reinsurance companies are the ultimate unsentimental scorekeepers of human health and economic stability.
Right.
They don't deal in hope. They don't deal in marketing. They deal in hard actuarial data. When they report record profits driven by better mortality rates, it is a deeply positive signal about global resilience.
They are mathematically measuring human survival and realizing we are doing noticeably better than the historical models predicted.
Which leaves us with a final thought to ponder today. RGA is actively betting billions of dollars of their own capital through longevity swaps and massive life insurance portfolios that medical advancements, specifically drugs like oral GLP-1s, will fundamentally extend human life and health spans across the broader population.
To them, it's not a medical theory or a wellness trend. It is a billion-dollar financial position.
If the smartest actuaries in the world, the people whose entire job is to mathematically predict death, are literally banking their bottom line on a healthier future, well, perhaps the overarching narrative of human health is much more optimistic than the daily news cycle suggests. Next time you look at the global economy, don't just look at the shiny tech companies on the surface. Think about the rebar hidden inside the concrete, quietly calculating the odds and betting that the structure is going to last longer than we ever thought.